morning, everyone. Today is May the 9th, and I'm your host, Anne-Marie Band, for the Daily Edge on the Place Your Trades Network. We are the network that focuses on trading daily options using the CME Group's event contracts to trade mini S&P, the NASDAQ, Dow, Russell 2000, gold, silver, euro, crude, nat gas, copper, and now Bitcoin. Today's broadcast is brought to you by Tradeovate, which has built a custom app dedicated to trading CME Group's event contracts. You can trade them on the custom app or using the dome on the main. And here we are at the Place Your Trades dashboard. We'll take a look at the wonderful new tools that we've got. Of course, we've got our quant stats that show us what our probabilities are for closing above the open, and my favorite new set of tools from Quick Strike for the event contracts, giving us where we are in terms of pricing and where we might end up by the end of the day. I really, really love this. And I am super excited to introduce from SentimenTrader, Dean Christians. Hi, Dean.
How are you?
I am doing really, really well. It's always super exciting to get to talk to someone who's got an institutional background. And so what I'd like for folks to learn about more is what brought you up into the markets, and to learn about your walk through the trading space.
Sure. So just to, and again, thanks for having me on the show today. Yeah, just a little background. So I took a futures and options class my senior year in college, and half of the class was finance majors and the other half were ag econ majors. Of course, the ag econ guys were learning how to hedge their crops, and the finance people were just learning about how to speculate using futures and options. And I really loved it. And so that kind of led me right out of college. I went and worked at the Chicago Board of Trade in the 30-year bond options pit. This was back in the mid-'90s. So, there's still a vibrant floor presence. And stayed a few years there. And then I left right around that time. A little company called Netscape went public. And this was really the first company that just, exploded on the internet craze. And so I went and became a SOS bandit. And did that for a little bit, and then finally got into the institutional buy-side trading business. Worked at a large cap growth manager in the late 90s, and then for the next 20 years. So it was right there at the peak of the NASDAQ and all that craziness in 2000. But spent 20 years working for an institutional money manager, which was a great experience for me. As we talked about before, I got to see a lot of different research from the street. We did business with a lot of brokers. So I was able to really take in all this different kind of various research. And what it led me to is to gravitate more towards technical and quantitative analysis. And that's what I do today for SentimenTrader. So
Excellent. That's a really interesting walk through from really the beginning space, picking it up in college and then moving on to that space. If you look back at that time, what did you like most?
Well, I think probably spending the time at the institutional money manager. Again, it was just having access to research analysts, to strategists, to technical analysts, and that's really what sort of shaped me as an investor, a trader, a research analyst, and I gravitated more towards the quantitative technical analysis way of analyzing markets. And again, what we know with that sort of quantitative signal driven approach is that it helps us to sort of remove the emotion from the game. We know that trading investing is really difficult, and what most traders and investors struggle with is that behavioral aspect of having the confidence to pull the trigger and then being able to manage a trade appropriately. So much of it really is, just this psychology and behavioral aspects of trading. And so that's really kind of what we do at SentimenTrader is we take a quantitative, signal-driven approach, so that we can manage risk relative to probable reward, and that's what trading is all about. Is managing risk relative to reward.
The great skill set that you've brought along the way is really the structure of knowing that kind of quantified approach is really what brings results. And even though we can have ideas about macro and whatever, it all boils down to these trigger points that you have to measure so that you can get better. You actually had a great quote that you talked to me about just before we went live about the nature of how SentimenTrader works. I'd love for you to share that with everybody.
Sure. This is a quote that I've loved for a long time, and it's by a gentleman by the name of George Chestnut. And George said, "The best forecaster of market action is the action of the market itself." And and again, that's what we really do. We study market action through an objective, signal-driven approach. So we can manage risk relative to probable reward. And again, just tying it back in with psychology, just again having the confidence to pull the trigger on a trade and then manage that trade, appropriately. That quantitative approach helps us to do that. So some of the the things that we look at when we create a signal for maybe gold, or it may be crude oil, or maybe S&P futures, is we'll look at the median return, the average return. We'll look at the win rate. We'll look at the Z-score for that signal, which basically just tells you, does that return over this period, is it significantly better than what you would have just gotten over the entire study period for that time horizon? And then really probably the most important statistic is looking at that median max loss and max gain, because that's what gives us sort of the framework for placing a trade, where we know, okay, look, our median max loss is X, our median max gain is Y, and then we can use that as our framework. We can say, all right, well, based upon history, here's what our median max loss is. We might want to put a stop right just below that, and then with our median max gain is this percentage, and that's where we might want to say, all right, look, at this point in time, let's take profits on that trade. And that's really what we do is provide that framework for our subscribers so that they can manage that risk.
Do you have a specific example that you could put up on the screen and show us what you
Sure.
mean?
So this is a research note that I published. I guess it was probably about 3 or 4 weeks ago. And this is crude oil. And at the time, what I framed this was just a tactical trade opportunity, because if you look at the chart of crude oil, it was in a clear, defined downtrend.
Yeah.
And as traders know, typically what you want to do is in a downtrend, you want to short overbought conditions. If you're going to try a mean reversion trade, it's just that. It's a trade, not an investment. But crude oil cycled from a 2-month low to a 2-month high in only 12 trading sessions. And actually, if you look at the chart, it actually went from a 1-year low to a 3-month high. But when I looked at all the signals that occurred under those parameters, you only got 3 in history. So I had to loosen the parameters a little bit, and I said, well, let's look at a 2-month low to a 2-month high, and I had to ease it to where I had to use a 1-month time frame for that requirement, and basically what that did was provided us with an outlook. So if we scroll down, which it's not letting me scroll down now. Let's see. Well, are you able to scroll down, Emery?
Oh, I can't. I'm just seeing your screen specifically, but if you went to your actual browser, you probably could scroll down and not think
Yeah,
about,
let's see. Okay.
yeah, there you
Yep.
go.
Okay.
Yeah.
So, what I was talking about here is our statistics for crude oil, and what you can see is that you saw some soft results in the first few weeks. Again, that's not a surprise. When you have a big strong up move, that you have a little pause consolidation. But what you saw is over the next 1 to 2 months, you had a win rate of 61%, 67%, and then you had some nice median gains. And what you also saw was significance. So, those median gains were significant relative to the median gains over the course of the study. And then,
So
of course,
sorry, you're using confidence intervals to have those um, numbers
yeah,
where you say significant?
yeah, yeah.
Okay, okay, okay. Hmm.
So, so again, what this does is just provide us with a framework that we can see, all right, well, look, our average max loss here is negative 5.9%. Over the next 2 months, our max gain is 12%. So, again, what I was saying earlier is we could place a stop, say down 7% maybe, or somewhere of that nature. And then we're managing our risk relative to probable reward. And again, this is sort of our bread and butter here of what we do, and all of our research notes is to provide subscribers with an outlook table like this one for crude oil.
Do you have a defined time frame that you will say, hey, this is a particular trade, it should go for this long, or do you use time as a structure of your forecasting?
Sure. So typically, for trades, it's just up to 2 months.
Okay,
So that's
gotcha.
that's what I typically use is up to two
Hmm.
months. For obviously, if it's an investment, then we'll look at those longer time horizons. But as we all know, commodities are not an investment. They are a trade.
Yes,
They
they
are
certainly are.
they are mean reverting, financial contracts or futures contracts, and so yeah, up to 2 months. But again, it may not go that long. We
Hmm.
may get stopped out. We may hit a profit target, and then we're out of the trade, and then we're back on the sidelines waiting for the next signal to occur.
Okay, so let's say a signal occurs, but you get stopped out. Mechanically, are you still looking at that particular price action event? So, for instance, if I pop up my oil chart right now, Sav, if you could help me with that. We've got oil sitting over here on the left, and we also have the event contracts sitting here on the day for what's oil. Now, I'm not really sure. Are you familiar with the event contract, Dean?
I have not. No, I have not traded those
Okay,
personally.
so they are fixed risk, fixed reward, and of course they expire at the end of the trading day. So the cycle is very quick, but using something like SentimenTrader that gives you price action events that say, hey, listen, the last time this happened, it was several months of real big motion in a very tight area. So we know this area is very important. We can really end up trading around those zones in a super specific way. So what we have here for oil is sitting in a space like this that says, hey, you know, you talked about the high to the low moving in such a very big space, and we did drop out because of that employment numbers thing. It sort of really pulled that edge out. And I think outside of that, it might have been something that held much more attractively. But overall, what we can see is that using these numbers, I would suspect, since they are only occur in a very odd time, meaning not very often, we can revisit them over and over. Can we not? What do you think?
Yeah, sure. So, what? with these event contracts, like you say, given it's just for the day,
Uh-huh.
you got to obviously you have to shorten your signals.
Oh,
To
certainly,
very very
certainly.
short term. So I mean, just looking at this candle here, I was watching actually oil that night.
This
You had
big one?
oil drop about $4 overnight and then
Yeah,
recover. Most
yeah,
likely the stops got blown out down there,
yeah,
or there
for
was some sort
sure.
of liquidation for a fund. What's interesting, Embry, is this move down. I also looked at that, and I put out a research note on energy stocks, but crude moved down 15%, 15 days, and it did it, within like 15 days of a 6-week high, and that's pretty unusual as well. So that's only happened 16 other times since the contract started trading in 1983, the futures contract. Um,
And
so
did we see
what we've
upside?
seen. I'm sorry.
Did we see upside from there, from those big range expansions, or did they go in both directions?
Well, so what I looked at was actually what would happen with energy stocks, and energy stocks showed a downside bias to them over the next few weeks, and it was a pretty good, strong
Interesting.
downside bias. Again, I would like to make the point,
Sure.
just what we're seeing with this price action is this is the type of market that for someone like me, I would walk away from. And the
Right.
reason why I say that is because all of a sudden when my signals start to pick up stuff that hasn't happened very often,
Hmm.
reversals that have only occurred, 13, 14, or even fewer times in over a 40-year history.
Right.
Something's going on, and the volatility, for me personally, just given the way I trade, is it's too high, it's too crazy for me, and that's the type of thing where I just say, you know what, I'm going to walk away. I'll go look for signals in some other futures contract, or
Right.
some other market. But
Well, it I think it's true that if it's also important to know when not to trade. And
correct.
so that you have to go where that edge is sitting. And if you're not in a space where your signals keep risk boundaries carefully defined, you're going to have a problem. So when you see something crazy like that and you step aside, what do you wait for to make it settle down? What kinds of things do you look at that says, okay, my edge is going to redevelop in this particular environment?
Well, I mean, uh, whether it's crude oil or even like right now with the stock market, you're in these ranges,
Yep,
and typically if you don't recognize that range very quickly, you're going to get chopped up.
yep.
These signals that you see are going to fail real quickly, and you'll see it. So I like I said, I tend to walk away. Um, Let volatility calm down. I mean, you can watch obviously for crude oil now, there's a VIX type contract, and I actually have a trading signal for that. But so you want to maybe see implied and realized volatility just sort of settle down a little bit. And they're
So
these
what's the
big.
ticker? What's the ticker for that realized vol? Do you have a
Well,
picture of it?
I don't have it in front of
Okay,
me.
no
I
worries.
use I use TradeStation, and of course
Uh-huh.
everybody's ticker is different. If you go to Bloomberg, they may have a
Yeah,
different
yeah, yeah.
ticker,
Sure, sure, sure.
but yeah, I don't have it in front of me. I could get it,
Yeah,
but again, just watching realized and implied volatility, I think is important. And even you could, if you don't watch that, you could do something like Bollinger Bands.
yeah.
Bollinger Bands, and just look at the spread between the upper and the lower band, and the wider that is, the greater the volatility. So when you have those just crazy volatility signs, again, it's best to sort of just take a step back, look at the big picture. Where are we? Are we in an uptrend? Are we in a downtrend? Are we in a sideways market? And then from there, you sort of um, just manage where you are in relation to the broader big picture.
What would you say say to the trader who's listening to tons of macro news, really trying to balance that out in their mind, and then having them look at a chart and seeing something that says something different to what they think their macro view is? How would you suggest to the trader listening, how would you help them separate their decisioning stats from the stuff that they listen to all across the gambit?
Well, we often say this, follow the signal and ignore the noise.
Right,
And listen, if you're on social media, you're going to get a lot of noise,
right.
especially something like Twitter. And again, the best thing you can do is really just tune it out. Have a process, have a plan, and maintain the discipline to keep that in place. And really from a big picture, top down macro, look, if you're trading oil, you're going to get all these headlines, all this news. Probably your best bet though is just follow more of a long-term price trend indicator. That could be something like the 200-day moving average. Are we above or below it? Is the 200-day moving average rising or falling? That'll probably give you a pretty good big picture view of sort of the macro underlying fundamental pinnings of crude oil or really any other commodity, and even the stock market. And so that's sort of your big top down macro view. And then we can shorten our time frame, and look more intermediate to short term trend following measures, to where then that's how we would want to position and trade around the big picture. Of course, and people lose sight of this, and it's a very simple concept. But in an uptrend, you want to buy oversold conditions in an uptrend. In a downtrend, you want to sell overbought conditions. And obviously, it's easier said than done. Um, but if you just sort of take that sort of view, and again, you have a process that you follow, you can be successful. But it just requires a lot of discipline.
So, what you actually just talked about was the the general mean reverting type of trade environment, right? You sell things that are overbought, you buy things that are oversold within a relative trend that fits that way.
Right.
And what I've noticed in this particular market, that a lot of people who are looking at those kinds of trades are um, really getting smashed. I mean, if we think about the bond market, for instance, those guys have all been mean reverting, and if a lot of them didn't have their paychecks ready, they'd probably be living under a bridge down by the river. So that question of when do you look at mean reverting and say, wait a second, is this really the time for me to mean revert? Or what should I do to help with that sort of strengthening of the mean revert? Because obviously the law of large numbers tells us that's eventually going to happen. But as they say, the market can be irrational longer than we can stay solvent. So what kinds of tools does SentimenTrader use that says, hey, this might be mean reverting, but here's something additional for us to consider in the way? I don't mean to sort of throw that on you, but that mean reverting narrative has really gotten a lot of people in trouble over the last little bit because of things getting very outsized in their motions.
Right. Well, look, the most difficult thing. So first and foremost, what we try to do is take a weight of the evidence approach. Okay. We don't ever want to rely upon a single indicator, because a single indicator will it
Yeah,
won't work sometimes.
absolutely. Right.
And the idea is, you know, let's use a weighted evidence approach. I'm a big fan of composite models. So
Uh-huh.
I'll throw, you know, and let's just use the stock market as an example. I have a composite risk warning model, and I have 10 different, you know, algorithms in that composite risk warning model. And most of those are breadth based type of model. There is a sentiment model in there. But the idea is that, you know, you're in an uptrend, price is going up, but the internal condition of the market is starting to weaken, and that's what breadth tells you. And what the composite model will do is it'll say, okay, look, internally we're weakening. You need to be mindful that we could have a mean reversion trade against the underlying uptrend. And I actually got a signal in January of 2022 that gave us that warning that said, hey, you know, we're going to get a mean reversion move down against the prevailing uptrend in stocks. And it was a very timely signal. But again, it's you know, to your point, it's very difficult to know what is a mean reversion trade against the trend that might extend even further lower, and then you're
Yeah.
questioning yourself, oh my gosh, is this
Yes.
a trend change? Are we transitioning from an uptrend to a downtrend, from a bull market to a bear market? And usually what I do, again, I have another composite is that's called it's a composite recession model. And when you have big corrections in the stock market, it's usually because of a growth scare. When you have a bear market, a major significant bear market, it's usually because there's a recession involved. So having a framework for identifying what is a growth scare correction versus what is a bear market driven by a recession is very important. And so again, that's, you know, again, what we do is again, let's have a weighted evidence approach, because no single indicator is infallible. And you know, if you have that, you know, you're gonna like we say, you're gonna yeah, tip the probabilities in your favor, you know, versus not having that, you
Absolutely. Absolutely. You know, my big takeaway from getting to talk to you is really understanding that, well, plus everybody at Sentiment Trader says all these great things about you being a guy that really has it together in terms of models to look at, is that your approach is very, very structured. And I think it's the one thing that the institutional um, buy side experience gives you, because you actually came up in an environment where you were always accountable to someone or some other process. And so as retail traders, that's the big thing that we don't have. So an anchoring inside of, you know, something like Sentiment Trader and gentlemen like you that really support everything that Sentiment Trader is all about, really adds a benefit space. For us as traders, we have to say, okay, I'm ready to stand beside a process, commit myself to a process, and hold myself accountable to that process. And once we have something that we can look at, then we can measure how good we're getting or how bad we're getting, right? In terms of those things. And that is a really great takeaway. It was a great pleasure to meet you, learn about all the things that you've walked through, which is really a complete space. To call yourself a SOS bandit, I've only known two other people that did that. So it's
know.
really super interesting. So we'll have to talk about that offline sometime. But is there anything that you'd like to leave us with from Sentiment Trader or from you as maybe a hard lesson that you've learned, or something that keeps you in the wheelhouse of strength every day? What would you say to the trader really trying to get better every day by developing an edge?
Well, yeah, I mean, look, you know, like, you know, trading is a profession, And like you said before, you really have to have a process. You have to have the discipline to carry it out. You have to have that willingness to study what you did right, what you did wrong, and it's a process that takes a long, long, long time to be successful at. And so, I would tell anybody that's looking to get into trading that there's no quick buck. It's a long game, and the main thing is that discipline, discipline, discipline. At the end of the day, that's what really, really matters. Cutting your losses short and letting your profits run has proven to work through history.
Absolutely. And way easier to say than do.
Yep, absolutely.
Well, thank you, everyone. Thank you, Dean. Thank you, listeners. Thank you, Place Your Trades Network. And we will see you all tomorrow for our next event on the Place Your Trades Network. Thanks so much, Dean. I
Thank
appreciate
you
it.
for having me on. Thanks, Anne Marie.